Hello and welcome to the Binary Institute's Risk and Money Management lesson. Today in our lesson, we're going to discuss the basic risk and money management strategies that will help you develop your personal trading strategy that will allow you to profit from binary options markets. Now, during this video, we're going to discuss what risk and money management are, but also how to create your daily trading allowance. We'll teach you strategies such as diversification, asset correlation, compounding, and many other important strategies that you can implement when you're trading on your own. Now, as you can see, we do have a lot to cover today in our lesson, so let's dive straight in. Now, first and foremost, when we discuss money management, we're referring to your personal strategy of how you will invest your funds in the capital markets. Now, this strategy is important because, statistically speaking, you will not win every single trade that you make. Even the best traders occasionally lose, so it's very important that you have a strategy in place that defines how much you will allow yourself to invest in each trade every day, regardless of wins and losses, but also what you will trade in. Now, risk management, on the other hand, is your personal strategy to maximize your profits from trading opportunities by understanding as many factors as possible that affect the value of an asset. Essentially, risk management is a decision-making process where you will carefully weigh the expected benefits of entering a trade versus the existing risk in the market. Now, money and risk management go hand in hand, as they are both personal strategies that you will develop and implement when you trade. Now, today we'll start by discussing a few money management strategies that you can utilize in order to decide how much money you will start trading with. Now, first and foremost, it's critical to have a daily trading allowance, or a certain amount of your total account balance that you will set aside to use for daily trades. In order to determine what our daily trading allowance should be, we'll use a strategy called compounding. Now, most traders have different account balances. Some of you will start with accounts around $250, while others with $500, maybe $25,000, or maybe $250,000. Regardless of the size of your account balance, you will want to break that entire amount into smaller trades. Now, if you have an account balance of $250, for example, and you do one trade of $250 and you lose your trade, your entire account balance is gone. However, if you would divide that $250 into smaller trades, you could do 25 trades of $10 each, or $50 of $5 each, depending on what the minimum trade is on your platform. By dividing your account balance into smaller trades, you can remove the risk of jeopardizing your entire account balance should you lose a trade. Now, most traders usually will allot a certain percentage of their account to daily trades. Usually this is somewhere around 10 to 15% of their total account balance. For example, if you have $500 in your trading account and you decide to trade no more than 10% of that, your daily trading allowance would be $50. You could then compound that $50 into 5 trades of $10 or 10 trades of $5. Now, when you're just beginning to trade, it's important to start small and practice your trading techniques until you're confident that you found your successful method. After a week or two, you can then increase the size of your trades in order to gain those larger profits. Now, another important money management strategy that we can employ is diversification, which helps us understand what we could trade on the platform. Now, one of the biggest benefits of being a binary options trader is that you can trade across 4 asset classes, which means you can trade currency pairs, commodities, stocks, or indices, or a combination of all of those. Now, depending on the type of trader you are, you may have more expertise or interest in a particular asset class, and that's perfectly fine. However, we do want to teach you a strategy that will help you yield higher returns, and this is known as diversification. Now, diversification is a strategy where you trade across a variety of asset classes. Now, by spreading your trades over several asset classes, you can remove any risk that affects a specific asset related to a particular company, industry, market, economy, or country. Now, we'll give you an example of why diversification is important when we're investing. Let's say that you're only interested in trading airline stocks. So you go ahead and open a few trading positions for American Airlines and British Airways. Your trades will expire in a week's time, but you feel very confident about these positions and you decide that you'll trade around 75% of your total account balance just in these trades. Now, the next day, there's a major announcement that airline pilots are going on an indefinite strike. All flights are canceled and the airline stocks plummet. Now, because you traded 75% of your total account balance into these trades, you just lost 75% of your account. However, if you would have divided your trades across a variety of asset classes and diversified your portfolio with currency pairs, indices, and commodities as well, only a portion of your trades would have been affected. So let's take a look at a diversified trading portfolio to show you how it looks and how it works. Now, in our example, we're going to trade using a currency pair, a commodity, a stock, and an index. For our currency pair, we'll choose the Euro-Japanese yen, which is dependent on the economies of the Eurozone and Japan. For our commodity, we'll focus on gold, which is closely connected to the US dollar and the Australian dollar. For our stock, we'll choose Vodafone, which is a British stock, and it's traded on the FTSE 100 index. And the index that we'll trade will be the Hang Seng, which is Hong Kong's major index. Now, as you can see, there's very little overlap between any of our assets. If something happens in the Japanese economy, it will likely have no effect on our stock, commodity, or index. If something happens in the British economy, it most likely will not affect our currency pair, our commodity, or the index, and so on and so forth. So, this diversification strategy will allow you to lower inherent risk in the market that could affect your trades when you're opening positions. Another money management strategy that's important for you to be aware of is called correlation. Now, correlation works very well in combination with diversification, and it's very simple to understand. Essentially, correlation is a tool that we use to measure how two assets move in relationship to each other. When we discuss correlation, we're usually talking about one of three types of correlation. There's positive correlation, negative correlation, and random correlation. Now, positive correlation is whenever one asset moves in one direction, the second asset will move in the exact same direction. Negative correlation, it's just the opposite. Whenever one asset moves in one direction, the second asset is going to move in the exact opposite direction. The last correlation we have is a random correlation, and this happens when there is no justifiable reason why two assets could move in the same direction. It's random. Now, it's important to mention that correlation is measured in degrees most of the time, and usually assets don't have perfect correlation. However, regardless of how perfect the correlation is or isn't, the directional movement that we can see will be helpful when we're choosing what we're going to trade. Now, in financial markets, the best example of positive correlation would be between gold and the Australian dollar. Now, Australia is the third largest producer of gold in the world, so whenever the value of gold increases, the value of the Australian dollar typically increases as well. Gold and silver are another great example of positive correlation, as both of these precious metals typically move in the same direction. Now, an example of negative correlation could be between the US dollar and gold. Now, as the US dollar and gold are both known as safe haven assets, traders will typically focus their funds on one of those assets at a time. They will usually not invest in gold and the US dollar at the same moment. So whenever the US dollar becomes more valuable, traders will usually focus on investing in the US dollar and won't invest in gold. Therefore, gold will go down in price in the short term. However, when the US dollar becomes weak, traders will usually then move their attention to gold, and the price of gold will move up. They move in opposite directions. Okay? Another example we have is random correlation. And this could be between WTI crude oil and Apple stock. Now, as you can see, there's very little connection between the two of these assets, and it's impossible to say that when crude oil goes up, that Apple stock will also go up, or will move in the opposite direction. But with a little bit of practice and research, you can learn about the correlation of assets and employ this strategy whenever you're trading. Now, let's take a moment to discuss risk management and how you can apply this to your trades. It's important to mention that we can never isolate risk in the markets completely. There will always be some level of risk or uncertainty whenever we are opening positions on the trading platform. If there wasn't any risk, all of us would be billionaires and the markets would essentially cease to function. However, there are steps that we can take in order to understand as many variables affecting the market at any time before we open our trading positions. Now, the first step, and one of the most important steps that any trader can do, is to understand the price movement in the market. Whenever we're trading, we're not simply guessing whether the price is going to go up or down. That's gambling, and that is highly risky. However, whenever we're trading, we can make educated predictions about what direction the price will move based upon historic price movement. Now, in order to predict whether the price could go up or down, we need to analyze the market by using a mix of technical and fundamental analysis. Now, technical analysis is the study of financial charts and graphs to look for price patterns where the price has reacted in a certain manner in the past. When we find those patterns again, we can trade with them. Now, fundamental analysis, on the other hand, is the study of economic, social, and political events that could affect the value of an asset. Fundamental analysis essentially explains why the price is moving the way it is in the markets. Now, for fundamental analysis, we can use tools such as the economic calendar and news articles that can be found on websites like Bloomberg, Reuters, Investing.com, CNN Money, Finviz. There are a variety of websites you can use, but by using these tools, we can understand the general fundamental environment to know what political and economic factors are affecting the market environment. Now, by using technical analysis and a mix of technical indicators, we can follow the price movement in the market and find the best moment to open our trading position so that we get the best strike rate for our trading contract. Now, if we take 10 to 15 minutes to do a thorough technical and fundamental analysis, we will understand what elements are affecting certain assets, what markets are more volatile than others at the current moment, and we will also understand when is the best moment to open our trading position. Now, you also may notice on your trading platform that there are certain risk management features available to you. Now, depending on whether you're doing short-term binary options trades or long-term binary options trades, you sometimes will find that you can manipulate your trades once they've already been opened. Now, a few of the features that are found on many binary options platforms are the sell feature, the double up feature, and the rollover feature. Now, the sell feature is a tool that allows you to cut your losses on a losing trade by selling the contract back to the platform if you see that the trade is out of the money. Now, depending on when you sell the option back to the platform, you will receive a portion of your investment into the trade back into your account balance. Another feature is the double up feature, and it's a tool where you can double your profits on an existing trade that's in the money. Now, if you notice that you're winning a trade, you can activate the double up feature, and the platform will open an identical trade for the asset with the same expiry time, the same type of contract, whether that's a put or a call, and the same amount of money that you put into the initial trade. The only difference about this second trade is that you will enter the market at a new strike rate, which will be the current price of the asset when you activate the double up feature. Now, you also will find the rollover feature, which is a tool that allows you to extend your current expiry time to the next available expiry time should you feel that your trading position needs additional time to be in the money. Now, by using these features, you can take control of your trades so that you can maximize your profits. Now, we've gone over a great deal of information today. We've discussed the importance of having risk and money management strategies. We've discussed the importance of developing your own personal trading allowance and how to compound your trades to know how much you should trade every day. We spoke about diversification and also asset correlation, so you know what to trade and in what direction. We spoke about the importance of market analysis and also a few risk management features that are available to you on many trading platforms. Now, we've reached the end of our video series. Between the lessons in our written course and our video series, you now have all the tools to be able to start trading independently with a greater understanding of what binary options are and how to analyze the markets to maximize your profits. Now, whether you're using technical or fundamental analysis, you are now prepared to get started on your own. So good luck to all of you, and thank you for joining us here at the Binary Institute.